Hello, everybody, and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where our primary focus is on assisting businesses of all sizes and their owners redomesticate out of volatile tax environments like Washington State to predictable pro entrepreneurship jurisdictions like Florida and Texas. Today, I am continuing my coverage on Washington State's Senate Bill 6346, which was delivered to the governor for signature on March 13th, and the implications of the so called millionaire's tax. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, together with a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Washington State's Senate Bill 6346 imposes a 9.9% tax on Washington taxable income exceeding $1 million effective January 1st, 2028. The first payments are due in 2029. That 2 year window is not a grace period. Rather, it is a planning period for sophisticated business owners, and the clock is already running. The numbers in the legislation deserve careful attention before anyone reaches for a solution. The $1 million threshold is not doubled for married couples. A household earning $1.2 million pays the 9.9% rate on $200,000. That is the marriage penalty embedded in the statute, and most people affected by it have not yet considered this important factor. At $1.5 million in household income, the Washington tax liability under Title 82A is $49,500, pushing the combined effective rate to a whopping 36.3% approximately. At $3 million, the liability reaches almost $200,000 and the combined effective rate approaches almost 42%. The rate applies to every dollar above $1 million, which makes aggressive reduction of adjusted gross income through legal deductions a central component of any mitigation strategy for Washington residents who remain behind. For those who do not intend to stay, the analysis is quite different, and this is where precision matters more than anything else. Redomestication, also known as changing the domicile of an existing business entity from Washington State to a lower tax or no tax jurisdiction, is a legitimate and well-established legal process. It is authorized under Washington law and the law of almost every state in the union in one form or the other. When executed correctly by a licensed attorney, it changes the legal domicile of the company, preserves the federal employer identification number, maintains existing contractual relationships and bank accounts, and avoids the legal and tax complexities of dissolution or merger. For a business owner who is genuinely relocating out of Washington State, redomestication of the business entity is an essential step, but redomestication of the entity alone does not solve the Washington income tax quagmire, and this distinction is critical. Washington's 9.9% tax will apply to Washington taxable income. That is not a throwaway phrase. That is the key point. That concept is defined by reference to the taxpayer's connection to Washington state, not merely by where the company is legally domiciled. If a business owner redomesticates their LLC or corporation to Texas or Florida, but continues to live in Washington, continues to operate their business from Washington, or continues to generate income with Washington state nexus, the redomestication of the entity has not eliminated their Washington tax exposure, contrary to what the armchair experts on Reddit have to say about the matter. Rather, it has changed where the company is registered, but it has not changed where the income is earned or where the taxpayer legally resides. A genuine move to a no tax state eliminates Washington tax liability only if the nexus connection is severed. In other words, it requires a total documented break, not just a paperwork exercise. Washington state, like California, will apply scrutiny to high earning taxpayers who claim to have changed their domicile whilst maintaining substantial connections to the state. The factors that tax authorities examine include where the taxpayer's primary residence is located, where their spouse and children reside, where they spend the majority of their days, where their professional licenses are held, where their vehicles are registered, where their social and religious ties are centered. Yes, I'm not making this up. Where their business activities are physically conducted. And in the case of California, they are even looking at IP addresses. I kid you not. A business owner who redomesticates their company to Florida, for example, but spends 200 days a year in Seattle, whose family remains in Washington, whose clients are in Washington, and whose operational infrastructure remain in Washington, has not made a total documented break. Rather, they have created unnecessary paperwork for themselves. Washington's tax authority will look through the paperwork to the underlying substance. This is not a hypothetical risk. California has pursued former residents who claimed domicile changes while maintaining California nexus for years after their nominal departure. Similarly, New York's residency audit program is among the most aggressive in the country. Washington, now entering the income tax space for the first time, essentially, will have every incentive to protect its revenue base by challenging paper departures that are not substantiated in reality. The planning window is now. Proactive steps, whether income acceleration to recognize gains before the effective date, structural changes to business arrangements, or a genuine relocation of both the entity and the principals must be executed before the tax takes effect for maximum effect. Actions taken after January 1st, 2028 address a liability that has already begun to accrue. For business owners who really are relocating out of the state, redomestication of the entity is usually the best legal tool available to formalize the company's move and preserve its continuity without disruption of finance or operations. It, however, is not a substitute for the underlying facts of domicile. It is the legal mechanism that formalizes a real, genuine change that has already occurred or that is in the process of occurring. The entity follows the person. The person does not hide behind what's written down on a few pieces of paper. If you own a business in Washington state and your income puts you above that critical $1 million threshold, the question is not whether redomestication is available. It is. The question is whether you are prepared to make the total documented break that severs tax nexus and converts a legal filing into a genuine and defensible change of domicile that will hold up under audit scrutiny. Half measures produce half results. And in this context, half results will still produce a tax bill, in worst case scenario, penalties, interest, and perhaps even claims of tax fraud, although all of that can be avoided when you work with professionals who know what they are doing. If you have questions regarding redomesticating your existing LLC or corporation out of Washington State or out of any other jurisdiction to one of the jurisdictions where I practice law, please use the link in the description for more information on the process and to schedule time for us to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. By the way, yes, I'm real, and no, I am not AI. Should you have any questions regarding this information or the content of any of my earlier series of presentations on this same topic, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for that conversation. I look forward to the opportunity to speak with and perhaps even work with you very soon.